Right now, most people think rich investors win in crypto because they have inside information, special connections, or unlimited money. But here's the reality most people don't want to accept. Rich investors don't win because they know more coins. They win because they build portfolios differently. While retail chases the next pump, wealthy investors quietly structure positions. And by the time the crowd notices, the risk is already gone. Most crypto investors build portfolios randomly. They buy a coin they saw on Twitter, another one they heard about on YouTube, and a third one because it already pumped, so it must be strong. There's no structure, no balance, no plan. Then, when the market drops, everything falls together and panic takes over. They don't know what to hold, they don't know what to sell, they don't know where they went wrong. Rich investors avoid this confusion entirely because they never build portfolios emotionally. In this video, I'll show you how rich investors actually build crypto portfolios, not based on hype, but on structure, risk control, and long-term thinking. We'll break down how capital is allocated, why some coins get bigger weight than others, and how smart money protects itself even when markets turn bearish. This is the difference between gambling in crypto and investing like professionals. And if you want calm, data-driven crypto insights instead of noise, make sure you're subscribed. This channel is built for serious investors. Core principle: rich investors think in portfolios, not coins. The first thing wealthy investors understand is simple but powerful. They are not buying coins, they are building exposure. Retail investors fall in love with individual projects. Rich investors focus on how each asset behaves inside a portfolio. They ask questions like, how volatile is this asset? How correlated is it with Bitcoin? How does it perform in different market conditions? This mindset alone puts them ahead of 90% of participants. Portfolio layer. Core holdings. LOW risk. High conviction. At the center of every rich investor's crypto portfolio is a core position. This is usually Bitcoin and sometimes Ethereum. These assets are not meant to moon overnight. They are meant to preserve and grow capital over cycles. Wealthy investors allocate the largest portion of their portfolio here because liquidity is high, risk is lower relative to altcoins, institutional adoption is strongest. This core position acts as an anchor. When volatility hits, it stabilizes the entire portfolio. Pattern interrupt. Most people get this backwards. They put the smallest amount into safe assets and the biggest amount into the riskiest coins. Portfolio layer. Growth assets. Structured risk. The second layer is where rich investors seek growth, but with control. These are high-quality altcoins with real use cases, strong developer activity, clear demand drivers. Position sizes here are smaller than the core, but large enough to matter. Smart investors don't bet everything on one altcoin. They spread exposure across sectors, infrastructure, scaling, data, liquidity. This way, they benefit from innovation without risking the entire portfolio. Portfolio layer. Speculative bets. Optional upside. Only a small portion of capital goes into speculative plays. Early-stage projects. High volatility tokens. Narrative-driven opportunities. Retail often puts 80% of capital here. Rich investors usually put 5 to 10% at most. Why? Because they understand probabilities. If one speculative bet succeeds, it can significantly boost returns. If it fails, it doesn't damage the portfolio. Risk management. Real edge. This is where the biggest difference appears. Rich investors always define risk before entering a position. They know how much they're willing to lose. They size positions accordingly. They never go all in. They never chase. They never average blindly without structure. Losses are accepted quickly. Capital is protected aggressively. Retail tries to be right. Rich investors try to survive. Pattern interrupt. Most people don't realize this. You don't need massive winners if you avoid massive losers. Rebalancing. HOW wealth is locked in. Another secret weapon is rebalancing. As prices rise, rich investors trim positions. They move profits back into core assets or stable capital. This locks in gains without emotional decisions. Retail waits for just one more pump. Smart money exits in stages. This single habit is why wealth compounds quietly over time. Time horizon. Thinking in years, NOT weeks. Wealthy investors are patient by design. They don't expect instant results. They understand market cycles. They build positions during boredom. They reduce exposure during euphoria. Time works in their favor because they let strategies play out. Retail jumps strategies every month. Smart money stays consistent. Even the best portfolios face drawdowns. Markets can remain irrational. Bitcoin still controls macro direction. That's why diversification, sizing, and discipline matter more than predictions. No portfolio is bulletproof, but a structured one survives. Rich investors don't win because they predict the future. They win because they manage risk better than everyone else. They don't chase excitement. They build systems. If you want to grow in crypto long term, stop asking which coin will pump next. Start asking, how should my portfolio behave when the market changes? If this video helped you think differently, subscribe for more data-driven crypto insights. And I'll see you in the next one.